So, good evening.
Good evening.
All right, very good. That's it. That's the energetic part of the presentation, and then we are done. First of all, thank you so much for taking the time to be here in the evening. One thing about coming back to the same city again and again, the proportion of familiar to unfamiliar faces, right, keeps going up in the correct direction. But it also means that there are more and more people in the room who have heard me over and over again. So I might just simply call on people who have heard me before to present part of the presentation. So beware, right? So a very quick show of hands. How many of you are currently or have been entrepreneurs? Oh my goodness, okay. For some reason I thought I'm going to be talking to academics. Clearly not, okay. So how many of you are academics? Either educators or researchers or both? Okay, that's a huge overlap there, which is healthy. I'm very happy to see. How many of you are policymakers? Oh, Anders, you're all alone, as usual. So that's it. Is there any category that I have not called out yet? Somebody who does not belong to this category, any of these categories? Yes, what are you? I'm a student. You're a student. Shouldn't we all be? Yes. So welcome. You're the only one who's student. Everybody else here are like kind of talking heads, it looks like. So only one person here to listen, everybody else to talk. And that suits me fine. But you're going to talk too. All right. So I think the idea behind this 45 minutes or an hour, whatever we have together, is for me to share with you some things that have come out of my research on effectuation, which brings me to the last show of hands. How many of you have never heard of effectuation or heard me present this stuff anywhere? What are we going to do? I'm like Al Gore, I have one slide deck and I keep repeating it everywhere I go. But I am actually going to try not to make a presentation on effectuation, because my task here is to talk about some other things that I have been working on and thinking about, especially in terms of equity relationships. But because there is such a huge connection between my original research, which is kind of my claim to invitations like this everywhere, that I will touch upon this just a little bit. And if you want to know more, we'll have to figure out some other forum where you actually hear about that in more detail. So I'm going to focus my presentation today in equity. And as all my presentations, one of the things I want to tell up front is I'm very, very happy if you want to interrupt me along the way. Raise your hands, ask a question, raise an objection, whatever you want. I have a nice slide deck, or at least I think it's nice, but we don't have to finish it. We will go where you want to go. So I just want you to feel free from the first minute on to raise your hands and ask me questions or move me to go some other places. But because of the promise I've made my Brit, I will bring it back to equity somehow. Okay? All right, so here goes. So let's start where a lot of our work usually starts. And since so many of you are already entrepreneurs, this guy is Mike O'Donnell, and he's a serial entrepreneur. He started like 20 companies or something. I think the most famous one is iCopyright. Have people heard of iCopyright? So this equity project actually started because Mike came to my class to give a talk. And of course, I teach at a top 10 business school, which means a lot of my students just have eye on the money, right? The zeros are very important to them. And they also have high opportunity costs to become entrepreneurs, but they all fancy themselves entrepreneurs either today or in the near future. And interestingly enough, a lot of them actually get involved in startup companies within 5 to 10 years of graduating. So I do know that many of them are potential entrepreneurs. But when you go anywhere in the world and you talk to people who want to be entrepreneurs but who are not already entrepreneurs, they will say, I want to be an entrepreneur, but, and they usually have 4 reasons after that but. What do you think are those 4 reasons? Trust me, you know this. Yes?
Not to have a fixed income.
Yeah, so I don't have a fixed income. Okay, what else? I don't have money.
Financial resources.
Yeah, I don't have financial resources. I don't have money. Different ways of saying I don't have money. What else?
Capital resources.
Yeah, there we go. More, I don't have money.
Human capital.
Oh, human, I don't know what to do. I have no entrepreneurial experience or knowledge. I've never taken Saras's class or Ted's class. Yes?
I don't have time.
Yeah, I don't have time. Another kind of resource. I don't have time because I'm involved in all these kinds of things. What else?
Haven't got the idea.
Yeah, I don't have the idea. Anything else?
Apprehension of the outcome.
Ah, I'm afraid to fail is what you're really saying, right? Yeah, you're not apprehension of the outcome if it's $1 billion, right? So, okay, so this is exactly what you hear. I don't have an idea, I don't have money, or the whole bunch of resources. I don't know what to do, and I'm afraid to fail. These are the 4 things you hear all over again. So Mike comes to class, and of course students say this, right? I don't have my students they think they have an idea usually, right? And they think they know what to do because you're in a good MBA program, right? So you think you know what you're doing. But they all have this, I don't have money. And I'm afraid to fail is also there, but I don't have money. And Mike looks at them and he says, what do you need money for? Right? He says, you're here at this great business school. There are plenty of printers around here. And there's paper. What do you need money for? Just go print. What do you print? I actually worked with a guy who did that in Singapore. And there were 3 guys, and they counterfeited US dollars during you can see what an adventurous life I have led as an entrepreneur. You don't want to know sometimes. So 3 guys who printed, and then they decided ahead of time who will be the fall guy. And the guy I worked with actually was the fall guy. So he went to prison for like 20 years, but when he came back, he had unbelievable amounts of money. Right? He wanted to be an investor in one of my companies. So, sometimes that works too. Right? If you plan ahead and you're willing to go to jail for a couple of decades, it works. So what was Mike asking people to print? Yes?
I guess notes of equity.
Yeah, he's basically saying all you need to do is print these things like shares in, what's your name?
Brian?
Brian Inc., right? All you need to do is to sell pieces of Brian Inc. And you can get all these things that you say you don't have. So my students are like, what? What is your reaction to Mike? Assume, channel Mike. I know I don't look like Mike, but I could be. He has kind of curly hair too. So what is your reaction? Mike is basically saying you don't need money. All you need is equity. Yes.
I can't stop thinking that, of course, you can sell shares for your idea, but there's still the whole legislation around it. You need to register it. You need to have
That's how I know I am in Europe. when people, almost anything you say, and they're like, oh, there is legislation around that. Yeah, okay. What is the legislation around that?
You need to have 500,000 in invested equity to establish a company that has shares. And then you have to report your financial statement. I think it's 4 times a year.
Yeah. Who cares about that? You can do that.
Of course.
Yeah.
Of course. Or find someone that can help you.
Yeah.
But it's pretty.
Is it really 500,000? This is one of the things I've been trying to find out. I thought Karin was supposed to be here. So I heard the 500,000 number. I also heard 80,000. Moving on toward 50,000. And I'm looking at Anders. And people said that there is some legislation in the works where it's going to go down to 1 kroner, right?
Depends on what kind of company.
Yeah, but just the basic APS.
That would be
80,000. Mm-hmm. So where did you get the idea of the 500,000 from?
Just thinking as a normal stock company.
A normal public
Yeah.
You plan to start a company and go public day one.
No,
Is that what?
what?
Nothing wrong with that. Is that what Mike is suggesting? I mean, he's clearly not suggesting a public company, right? He's suggesting something like an APS where you can issue equity, but you're saying you cannot issue equity if you start an APS here?
No, of course you can do that.
You can do that, right? So you have 80,000 kroner?
Yes.
Yeah, and so this is the other funny thing, right? Everybody has 80,000 kroner. If not, I think there is some organization or institution apparently in Denmark that will give you the seed capital as well, which is like kind of cool, right? Actually not very cool, but we'll talk about that hopefully later on. But in the US, of course, you don't have anything, but you can just simply print pieces of paper for the most part. You need a little bit of money to actually incorporate, but that's usually negligible, right? And you can do it yourself as well. So that's what Mike is basically saying. So you don't need anything of this. So this started a conversation in class on how do you do that? How do you actually start a company with pretty close to zero or 80,000 kroner, depending on how you look at it, and build everything from that. It turned out, so I was very, very curious, and I wanted to understand it. And the reason I wanted to understand is my old idea. So this was both an entrepreneur coming to class and trying to talk to students who want to be entrepreneurs from a practical perspective, but from a research perspective, I had also learned, and over teaching over like 14 years now, it turned out that this is actually, equity is actually an engine of effectual co-creation. Since a lot of hands went up, said you have never heard of it, I'm going to give you hopefully less than 3 minutes summary of 15 years of research by about 40 researchers. So bear with me. And we may not be able to get into as much depth, but as I said, we'll find other forums where we will. So when you look at expert entrepreneurs and how they build companies, and those of you who heard me present this yesterday, I apologize in advance, and it's just going to be a refresher for you, right, in case you have to take an exam. So when you look at people who have built companies, who have deep and very broad entrepreneurial experience, multiple ventures over 15 years, including successes and failures, and taken at least one company public. That means they have been through all the possible experiences of entrepreneurship. And when you go and look at how they actually build the venture, you get this model, which I'm going to go over very quickly, right? A lot of them, and you will see each of those 4 objections, right? I don't have an idea, I don't have money, I don't know what to do, and I'm afraid to fail. All of them actually kind of get answered in the model, even though it might not be obvious. I'll kind of spell it out for you. So they say you don't have to start with a brilliant idea. In fact, it's very, very good if you don't start with a great idea, right? Just start with who you are, what you know, and whom you know. And ask yourself, what kind of venture can I build today, right? So I teach a class, I tell my students, you get all of tonight, and tomorrow morning when you wake up, you are going to be an entrepreneur and you are going to be working on your first or your next venture, depending on whether you had any entrepreneurial. So the idea is you just ask yourself, given who I am at this moment in time, right? Given who I am, what I know, whom I know, what kinds of ventures can I build? And here's the thing, you don't need much money. You're not going to invest anything more than you can afford to lose. So some people may be able to afford to lose 80,000 kroner, which hopefully you don't lose, you just invest in the beginning. Or some people may say, for example, you don't have to resign your job. You can work evenings and weekends if you feel you cannot really work full-time on this because you have a family to support. Maybe some people can actually take a leave of absence for 6 months and do it. So that addresses the time issue, right? So you actually figure out what is it that how much time do you have? Of course, if you have 0 time, you cannot do it. And even there, though, I have actually seen couples where one person doesn't have the time, and so they have the other person do it. Or the other person actually goes and takes a job, so this person can resign and do it. So there are ways to come up with an affordable loss level, right? But if you cannot come up with you're not going to do it. So the idea is you're going to invest no more than you can afford to lose. And almost the first thing you're going to do, like when you wake up in the morning, having decided, here's something I can do, what are you going to do? You're going to start calling people. And you're going to start working with people. And when you work with people, what you're trying to do is you're going to try to bring people on board. And the interesting thing is you're not going to tell them, you don't have a brilliant idea. You're not investing enormous amounts of money. So you cannot go and tell them, oh, I have this great idea. Here's why you should buy, or here's why you should invest, or here's why you should build my website. Instead, you actually start talking to them and say, I have this idea. What would it take for you to become part of my ventures? So that's why the word co-creation, right? You're getting people to get interested and commit things that they can afford to lose, right? So they're also not going to commit anything more than they can afford to lose. But every time somebody commits something to your venture, you start getting your resources start going up a little bit, right? You have co-created resources. It becomes who we are now, and the two of us together call someone else. But it also changes. The idea changes depending on who comes on board and what they want to invest and why they are investing. And over a period of time, this converges into something new. Along the way, there are all kinds of surprises happen, good and bad, but it ends up, I'm just going to put the future. It could be new products, new ventures, new opportunities, new markets. Question?
Yeah.
So in the initial stages, people are coming on board, and that is shaping. But as you go forward, right, some things start converging. Some pieces become fixed. But there are always other pieces that can be created new, and even the existing ones in many ways can be reshaped. So if you look at the story of Starbucks, for example, right? They start with a little store in Pike Place Market that just simply creates, ground coffee in packets. Then they realize that they have to have people actually taste the thing. And then so they actually start brewing some coffee. Then Howard Schultz walks in the door. And this is a profitable business at this point in time, right? Howard Schultz walks in the door because he's the guy, sales rep for the plastic cups in which they are giving these sample coffee to people. It's not a coffee shop yet. It's just a shop that sells roasted and ground coffee where you can taste the coffee before you buy the packet, right? So Howard Schultz walks in, and then he falls in love with these people and this idea and this passion. He's not even a coffee drinker. Now he goes off and he says, I really love this. I want to come work with you. He leaves the plastic company and comes to work with these people. But he's very, very ambitious. He's a sales guy, right? He's not satisfied with his little shop in Pike Place Market. And he keeps trying to convince the founders, we should start something bigger. We should, franchise. We should go and stuff like that. And they're like, oh, forget it. We all have full-time jobs. We are doing it for the love of it. You're not even understanding the first word of first syllable of passion, right? You're all about the money and stuff like that. So he goes away and he says, what can I do? And he goes to Italy, happens to go to Italy for a vacation, comes back and decides to start actually a coffee shop. The 3 original Starbucks founders will not work with him. He starts Il Giornale is the name of the coffee shop. And slowly he works with the people who come into the coffee shop on what that coffee shop should be. Initially he wants everything Italian, so he has opera music playing. Well, some of the customers really, really hate it, right? So people are coming and telling him, it's great, but we hate the music, right? And slowly, and he doesn't always take everybody's advice. He's shaping this, right? So he also gets to have his vision, but other people have other visions. And now he has to go from 3 coffee shops to 300 coffee shops. So all I'm trying to say is that every stage, right, once you have a coffee shop, it's functioning, you're not changing it every day. But as you create it, the next thing comes along, the next mountain comes along, or the next opportunity comes along, something new happens. So for the new thing, the effectual process is always useful. And I can give you example after example after example of people partnering not with other people, but with companies, with non-profit organizations, with government organizations, with hospitals, with churches, you name it.
But just really quick, then the co-creation part of it, how strong shall it be before you would call it an effectual
Now we are getting into definition. I don't care if nobody ever calls it effectual, right? When you write for journals, they expect you to come up with these things, so I come up with. Don't worry about it. What is the idea behind effectuation? What is the idea behind this model? And that is exactly the idea behind equity, and I'll show you in a minute. What is the idea behind it? Since you have read the books and done the work, I'm going to give you a chance. This is your exam. Be careful. So what is the idea behind effectual? Forget the word effectual. What makes something effectual? The litmus test.
Yeah. Well, I would say that they co-create some idea, and they shape something together into something new. So both of them have an influence on the product or the market or...
But what's the litmus test? Co-creation is an important part, but you can do effectuation without co-creation.
Oh, yeah.
The important part is that you are not going to try to predict the future. So the important part is whether you're trying to make a bet based on, so you and I can get together and we can bet on the future because both of us believe that that's where the market is headed, right? Then it won't be effectuation. So co-creation is extremely important for effectuation, but co-creation by itself doesn't work. It is really your attitude towards the future that's the key here. Are you making your decisions based on your beliefs about the future, about predictions about the future, or are you only working with things within your control? That's the real litmus test. You see? So, and you can use it in many, many, many different ways. Even though we have written about 5 principles, there may be 10 other principles out there that I don't know about. That's why other researchers are working on it, right? So does that answer your question? Okay? That's kind of a long research question. You can always sidetrack me by asking a research question. I apologize for that. So here we go. So let's understand equity. So going back here, why is equity the engine of effectual co-creation? Why is equity very, very important? Can anybody tell me? I'm going to get to that in a minute, but I just want to know, why is equity key to building ventures this way without depending too much on trying to predict the future and to work with things within your control and to co-create the future? Why is equity so important?
Mental security?
Pardon?
Is it mental security that creates?
How? Stay with that for a minute and tell me, how does it create mental security?
So it can basically anticipate somehow the behaviors in the future.
There we go. If you do that, then you're not being effectual, right? So the whole idea is not to anticipate what will happen in the future. Equity is a beautiful instrument where you don't have to anticipate what happens in the future. So let's talk about that in a minute. Let me actually get you, let's understand equity. And to understand equity, I want you to introduce a philosophical notion first. Okay? Donald Davidson is a pretty renowned philosopher, or was a pretty renowned philosopher. He passed away, who spent his entire life. He's called a philosopher of mind, right? Somebody who really takes, cognitive science, neuroscience, robotics, computer science, all those things really seriously in understanding reality and in understanding knowledge. So ontology and epistemology. So Donald Davidson spent a lot of time, and he wrote a couple of really provocative pieces. So the traditionally people have talked about, subjective and objective, right? So he talked about this tripod. So traditionally we know about subjective and objective, and recently in philosophy the trend is to think that the subjective is more important than the objective, because the way we actually create categories in the world actually influences our perception of reality, but in some ways reality itself is kind of constructed through the mind. So he wrote an essay called The Myth of the Subjective, because he says in actual fact, we all live in the same world. Even what we call subjective is actually constituted of the same material as the universe, right? Because we are physical beings. So when we say we are seeing something or we are thinking something, what we are saying is, there are these light rays that hit our retinas, and then they get, processed by electrochemical processes in the head. That's what we call subjective to begin with. But it is by itself, it doesn't work. When we say we know something, when we say this is black, it's not enough for the neurons in our head to kind of tell us this is black. It is also intersubjective in that your neurons have to give the same message as well. Only then you call it knowledge. Otherwise, it could just be delusion, right? Which is the idea of science. And then he talked about the interesting thing that people worry about is, we are all so different, and so how are we going to come together? And he said the interesting thing about human beings is we are all so different, and yet our differences are based on this shared experience of being part of the same universe. And so the interesting thing about us is not that we are different in the sense that we cannot agree, but that we are so much in agreement on so many things that's the surprise. It's much more surprising. So he talked about that. And as you can see, you would think philosophically why that would be interesting to somebody who's trying to understand co-creation and inequity. But even if you don't, it's fine. I always think the only way you know something is important and interesting intellectually is if you can actually think about it connecting with the bigger idea. So I start with a connection to the bigger idea. So let's get to the notion of intersubjective and how this plays into entrepreneurship. So let's get practical again for a minute. So normally, we think about things as interpersonal, right? The emphasis on differences. So when we think about stakeholder relationships, right? Customer, trying to bring a customer on board, an investor on board, an employee on board, we are thinking about what does that person want? What do I want? We're thinking about negotiation. We are thinking about our differences and reconciliation. We're saying, how do we arrive at agreements, given that we have all these different strengths and different weaknesses and different preferences and so on. Now, Davidson suggests, don't worry so much about our differences. Focus on what is actually common between us, and then we say, how can we use these commonalities to actually co-create the future? And that's why the notion of intersubjective, getting away from this idea of interpersonal, that we are all separate human beings, but to understand that we are all part of the same kind of reality and we are even made up of the same reality is important here. Okay? So the practical example. What is the alternative to equity? If you don't fund your venture through equity, how do you fund it? Family and friends, but what is the relationship? They give you money because they love you? Do they expect it? So that's a good one. I mean, why are you laughing? You don't have anybody who loves you and will give you money? That's pathetic. What's your name? We all have people who love us, but they usually don't have money to give us. That's the real problem, right? It's not that they don't want to give us, but they don't have money to give us. I have experienced that. But I've also experienced people who have money and don't want to give me, but that's fine too. So one is to say, when you say people are just giving you money, right? So I'll just put gift is one. And there are other ways they give you, right? You can always have a rich uncle or a rich aunt die. That helps, and they leave you some money. So gift works, is an alternative to equity. What else? Loans. Okay, so loans. Anything else? The gifts are sometimes from the government if you're in Europe. But you have loans, what else? So gifts and grants. And they are kind of in between. Grants are in between. What else? Any other alternatives? That's pretty much it. Either somebody gives you some money, or they lend it to you, or you have equity. So let's think about, I want to get into the structure of these two before when we say we have to understand equity. How many of you have actually taken a loan? A lot of people have taken a loan. So when you take a loan, may I ask you where you took the loan from?
Bank.
A bank, okay? Makes me very, very happy. I'm an entrepreneur. I don't like banks, but I know how to act like a hard-ass bank. So I'm the bank. You're going to come borrow from me. Okay? Let's think about how a relationship goes. Okay? So tell me what you want the money for. And how do you approach a bank? And assume I am a bank. Danske Bank, whatever bank.
You have to have an idea. I mean, it's for an apartment, so it's very usual.
Sure, it's a mortgage for an apartment. It's perfectly fine.
You have to seem convincing and persuasive.
No, don't give me a lecture on how to do it. You are my bearer. I am the bank. Talk to me. Your name is?
Louisa.
Louisa. Hello, Louisa. How may I help you?
I would like to borrow some money to purchase an apartment.
Okay. Everybody, be a banker with me. You'd like a loan. So normally what happens in a bank when you do that?
They throw you out.
You look a lot more credible than, I'm not throwing you out yet. I'm hard as, but not that hard as. I have to make sure that you're worthy of being thrown out. So what happens normally in a bank?
They want the credentials.
They want your credentials, right? They want to know as much as they can know about you that is legally allowed, right? I'm going to get to know you very, very well. I'm going to get your credit history, right? I'm going to ask all kinds of questions. You have a form to fill out. All of those things are going to happen, right? Everybody has experienced that. Anything I'm missing out, what else happens? Pardon? So it's not enough that I know everything about her that I possibly can in this world where apparently everything, all our information is available somewhere, to some people that ought not to have it actually, but it's definitely available to bankers. And so we look at it and then we look for collateral. So it's not enough that I know everything about you. I am actually going to say that I want some kind of a lien on the apartment. What else am I going to ask for besides the lien on the apartment? Because the apartment itself is collateral. Am I going to ask for more collateral than that?
Maybe a guarantee.
Down payment?
Down payment, right? I'm going to definitely ask you for if you have a $100,000 apartment or machine or whatever this loan is for, I'm going to have rights to that, but I'm not going to give you it's not 100% of the value of the collateral. I'm going to give you only 80% or 70%, depending on different countries and what you're asking for. So you have to come up with some kind of a down payment. What else? What else happens before I give her the loan?
Legal agreement.
Pardon? Legal agreement, right? Yeah. What is the structure of this legal agreement?
The relationship is important as well.
Okay.
There's a trust and so some kind.
To buy an apartment in Copenhagen? Really?
Well, yeah, I think so. That you have to seem credible, and you have to. There has to be some kind of.
Wouldn't that come up in your credit history? I can understand if you're doing this like in India or Rwanda or something. The personal, really, it becomes that's where you really they start asking for personal guarantees in a bigger way, right? But is it true in Denmark?
Yeah, well, I think so.
Okay. I saw your hand earlier.
Yeah.
So
They would probably also need to do some business and take a percentage of the loan, right?
So the agreement is going to involve all of these things. Okay. And not only we are going to give the money, we are going to say that you are going to repay more than the money you took, right? So what are the things that go into the structure of that agreement? You have the principal amount, you have the collateral, you have the down payment. What else? You have the interest rate. What else? There's one more thing missing. There's one more thing. This is not a trick question. There's one more thing. Everybody has been through this.
Prospective side of investment. So in the
This is an apartment.
the future, the value doesn't drop.
Oh, do they do that here?
Return
time.
Return time, right? You definitely have a time. That is not just interest. The interest is tied to a time. Because if you are not able to pay, if you fall back on an installment, or if you're not able to pay the principal, the interest rates keeps going. And then the rate itself can go up sometimes, right? Default rates, things like that. Okay? So we know the structure of the relationship, how it gets started, assuming that it's you and you look pretty credible to me. So the credibility issue aside, we get started. This is how the structure of this relationship looks. Now, let's look at what happens down the road. The future happens. Horrible things are going to happen to you. You're credible today, but then you're going to lose your job, you're going to have a bad marriage, and you have 2 kids, you are behind on your payments. Things go wrong, basically. What happens then in the case of the loan? This is the real structure of the relationship that you have to worry about, because we are dealing with the future here, right?
Insurance,
Pardon?
insurance on loan,
Insurance on the loan, so the insurance company is going to pay?
up to some.
Up to some extent, okay? So she has a bad period, the interest rate is increasing, but there is an insurance, some kind of insurance covers it. If she continues to default beyond the insurance, what happens?
The bank owns
Buyout, bankruptcy?
the bank owns it.
The bank owns the house at least. Maybe not you, but it definitely owns the house. Now, let's say you have a problem, but it lasts for 6 months and things go, and then slowly your life comes back again, a little bit, but still not enough to pay everybody. When does this thing end? When does this relationship end?
When you sell the apartment.
Yeah? So you can sell the apartment and repay, so you can become homeless for the most part, right? You can go bankrupt, or you can make some money and you're going to pay a lot more than you signed up for because you have accrued interest over time, right? Am I right? Is there any other? This is it. Now, think about this same thing as an equity relationship. What happens? Now, I want people, how many of you have actually done equity deals?
You cannot cover the risk, and you cannot demand repayment.
Okay. So explain that a little bit. You cannot cover the risk. What does that mean?
It means that the kind of collateral or pledge that you can have in any loan structure is not a legal possibility when you talk about equity.
Yeah.
And if you talk about equity in a kind of startup, there are no material assets to pledge.
Yeah.
So you have to. It's a kind of. It's a kind of bet. It's a kind of going to Las Vegas and try to make it the lottery.
Ah.
You don't have any bargaining power to push or pressure your counterpart or your partner.
Ah.
When you
So
are
how
at stake.
quickly you fell into the role of the investor, though, right? I didn't even suggest that you're the investor. So have you been an investor as an equity? Have you been an entrepreneur? Okay. So why did you choose the role of the investor very quickly?
Because I was a successful entrepreneur.
What does that mean?
It means that.
Why would that make you an investor?
Well, no, if you are an equity investor, and if you know what the life is like, being an entrepreneur, I think you have more skills and more empathy to co-create and avoid risk, and also you are more able to understand risk and accept failure.
Okay. Just for a moment, play with me and become the entrepreneur.
Yeah.
Now look at the same deal from an entrepreneur's perspective. From an investor's perspective, you said 2 things. Just repeat those 2 things so everybody's clear, and then we'll go to the entrepreneur. You cannot defray the risk,
No.
you said. And then what happens when things go wrong afterwards or things go well?
If things don't materialize as you expect, you lose your money.
Yeah, you lose your money.
Yes, you don't have any covenants or governance or
Okay.
any tools to be repaid. You must accept full loss.
Yeah. So you don't, you cannot say, you cannot ask for collateral and other things in the beginning. And then later on, when things go wrong, you cannot ask her to pay it back, even if she goes off and does something else where she's very successful, right? She doesn't owe you the money at all. Okay? So for a moment, what is different about this? From an investor's perspective, for a moment, and then I want to come to the entrepreneur's perspective. What is different from an investor's perspective? You told what is different in the structure of the relations, but as an investor, what are the things you are worrying about? We know as a banker, we want to know everything about her life and her career, and then but as an investor, what are the kinds of things? What is the difference? Yes.
Well, you can't recover your investment, so it's high risk compared to a bank. And you need to know more about the person who's going to carry out the plan.
So I need to know more than the bank about you. Is that correct?
Yes, as an investor, you have both the complete upside and the complete downside. As a bank, you have no upside, and you want to avoid the downside.
Yeah. So you have a smaller down. Seems like standard procedure, right? In terms of low risk, low reward, high risk, high reward kind of thing, right? This is the way. Now talk to me as an entrepreneur.
Well, as an entrepreneur, I would, meeting the investor, I would like to have the most amount of money for the highest possible valuation, and I fucking don't care whether it's clever money or stupid money.
Okay. So long as the equation works out,
Yes.
that's all you care about.
Yes.
As an entrepreneur.
As an entrepreneur, I would like to tell investors that I would prefer an investor with a clever mind and a deep insight into the industry and the business who can assist me and help me with network and experience. But by the end of the day, I'm not willing to pay for that. I choose the investor giving me the highest enterprise value.
You really want the stupidest investor, is what you're saying.
Yes.
Right? Because given your description of what the entrepreneur wants and the risk that the investor is actually taking, why are you stupid enough to be an investor
Yeah.
at all?
Sometimes I also ask myself.
So it's good. Let's have it in the open. And I'm asking you.
Why?
Yeah.
Because I think I can sometimes look through the haze and the darkness and the gray skies and see. I think I can recognize sometimes an opportunity and a fantastic team, and sometimes it succeeds and sometimes it doesn't.
So
I
the
think
investor is placing a bet.
yeah, very, very.
Okay.
Clearly.
What is the entrepreneur doing?
Creating value.
He says, I fucking don't care, right? Creating value for the investor or somebody else?
Both for customers and the investor. The investor takes a cut.
Okay. So you're saying as an entrepreneur, in that equity deal, what is the entrepreneur doing?
Or the entrepreneur is making the capital work, creating value, using the equity or the money to create a product or a great service, and then capitalizing on it and returning the money to the investor.
But you don't need to return the money to the investor. That's the whole point of equity.
No, when he sells it, you increase the company.
Only if you do well,
Yes.
right? If you do badly, you don't have to return anything to him.
That's why you need to put in some money yourself, enough till it hurts.
Why? He's willing to invest with you. He can see through the gray haze and, why would you want to invest your own money when he can do that? Because he is willing to place a bet on you.
I would prefer it if it was that way, but just not my experience.
So what has your experience been?
A minimum of 10% of the requested amount.
So the investor wants you to invest 10%.
Yeah, so if I'm asking for 100,000, I need to invest 10,000.
Oh, okay. And you invest, you're happy with that. It's kind of like the banker. It's like a down payment.
It's sort of. It's more committing for both parties.
Okay. What about you? Do you require them to do 10%?
Well, if I'm an entrepreneur, I say there is a lack of symmetry because I know much more about my business and my idea and my universe than the investor. So there is this moral hazard situation.
Is that how you thought when you were an entrepreneur? I know now as an investor, you see a lot of entrepreneurs do that kind of.
I never asked people for any money, so
Ah.
I didn't have that dilemma, but it certainly is it's a fact of life that there is this discrepancy between what you know and the investor knows.
Yes. It's very interesting what he said just now, right? Because a lot of the entrepreneurs, as I told you, who build using the effective model actually don't take in investment at all, and definitely not at the really early stage, right? And for me, it's always a surprise why people would want to actually do stupid money deals, right? Why would an investor want to invest unless they want to co-create? That truly is it's one of the intellectual puzzles that I have. I can understand why the entrepreneur would take the money. I have only 5 minutes more. Yeah. All right? So you were going to say?
Just that it's more that you'd want to be a part. It seems like the entrepreneur is trying to gather resources and more means, and the investor is, it wants to be a part of it, especially if you're not taking any, requiring any equity or any money put up by the entrepreneur. They believe in the vision, or they have been convinced that they can bring something in, whether it's just money or resources.
Mm-hmm.
Combination.
Okay, so when you think about this particular relationship between the entrepreneur and investor, what would a good deal look like? Like what are some of the things that would make this a wonderful deal? As opposed to, you have given good descriptions of bad deals.
Synchronized goals.
Synchronized goals, such as?
Such as same, we used to say same bed, same dream. Unfortunately, most entrepreneurs hook up with investors where it's the same bed, different dream.
Yeah.
And it's a challenge, I think.
And like marriage, right? You start with the same bed and same dream, and then people start dreaming differently. So there is also the relationship over time aspect to it, right? It's much more relational than the bank, because the bank, once you've structured the relationship, you've written down everything, and that's kind of it. And you already have baked into it, if bad things happen, if good things happen, if this much bad happens, if this much good happens, we have everything already. The interesting thing and the most difficult thing about equity is that you do not know. If you could actually predict the future, you could write a loan contract every single time. It is, and yet it is all the high upside rewards, the high risk, high reward we talk about, comes from the fact that we do not know what is actually going to happen in the future, right? So only in situations of high uncertainty, equity relationships are actually very good, and they are needed. So there is a contradiction in what you said. If you could look through the gray and predict this person will actually do well, you should structure a more loan-like deal. And if the uncertainty is very, very high, and your being part of the venture is actually going to make the venture more successful, that's the only way you should actually invest, right? So this is one of the things, and I'm going to talk to you just a little bit about if you have an intersubjective structure, which is what Ted is saying, same bed, same dream, we are building on our commonalities where together we can do something that is bigger than each of us could do alone. And it's really not only about the money. Those are actually the most successful equity investments. Like when you go to the Valley, you will find that. And I'm not talking about venture capital investments. And this is the interesting part. The most interesting equity deals are between co-founders, between stakeholder partners, right? Whether it's a corporate, customer, potential customer, or employees, and also with angel investors, right? People who are very, very early stage and who literally behave like partners to you and not like hands-off investors. So this is one of the reasons we think about equity only in the context of investment, but equity is really interesting not in the context of investment at all. It is in the context where we really are in bed together. So when you look at this particular thing about debt versus equity, I looked at all the research that is out there, and we know a lot about debt, right? There are 65 in-depth anthropological, historical, sociological studies, besides a lot of economic studies on debt, right? So if you want, those of you who are research inclined, you can read this review article, very recent, by Gustav Peebles. There's none on equity, okay? And definitely nothing on new ventures. And here are the economists. They talk a lot about equity, debt versus equity, incomplete contracts, complete contracts, all those kinds of things, but they're all looking at public companies, publicly traded companies in the stock market. Nothing in new ventures, right? Completely new area. We know very, very little about this. So I have been trying to find out, for example, how exactly in Denmark, I mean, this is a 20-country study, how do people actually structure equity relationships? And I'm really more interested in the equity relationships between co-founders and early stakeholders rather than the investor setup. And I'll give you some numbers on the investor later as well. So when you look at this research, what do we have? we have one study, okay? And I'm going to summarize that study for you. This is Hellman and Wasserman, and they looked at 1,476 founders in 511 entrepreneurial ventures, smaller teams, and teams with family ties. So interestingly, a lot of these families are not giving money as gift. They're actually taking equity. So if you have a husband and wife team or a couple of family partners, however the family relationship is, brother and sister, father and son, whatever it is, they tend to have equal partnerships. I've been talking to some people here in Denmark, and I discovered that a lot of partnerships, co-founding relationships, equity relationships between co-founders in Denmark is also equal partnerships. So one interesting question to think about is, if you want to structure equity relationships between co-founders, is there advantage or disadvantage to starting equally versus unequally? And then when you look at who are the people who do not accept equal terms, equal splits, it turns out that when people are bringing different skills to the table, which is what you want in a high-growth startup, and people, especially the more entrepreneurial experience the founding team has, the more likely they have unequal relationships. Why do you think that is? What could be the reason that the more experienced you are as an entrepreneur, the less likely you will go for an equal partnership? This should be an easy one. Yes?
Because if you have a completely equal partnership, you have also kind of veto right to any decision.
Yeah. So what happens if you disagree is a big issue.
Yeah, then everything stops, or you have to break down the partner.
Yeah. And also, there are other ways to worry about it. If it is just the two of us, something can also change if the two of us go 50-50. We may be in love, we may be great partners together. I get on a plane and I never come back, and all of a sudden my husband is your partner, right? so it's bad enough between us and the fact that we can change, but it also has all these other hazards, and when you have equal rights and you've not specified who gets to decide what, so decision rights are something to worry about. And the larger equity shares are received by serial entrepreneurs, people who came up with the idea, and the founders who invest their own money, okay? So this is what they found. But the interesting question is, should that be? So it looks like when we split equity, if you have somebody who has more experience, they will automatically get more. If they are the person who came up with the idea, they automatically get a little more. And if they're investing their own money, they get more. This is reality, right? But as an academic, I want to ask, is that the best way to actually split equity, okay? So the first question is, why do we care about equal versus unequal splits? And one answer is, what if we have differences? But there are also some more issues that they found, right? They said that in general, companies that have equal partners have a much lower pre-money evaluation, which is kind of interesting, right? They also find that the effect is more pronounced for teams that are quick to agree. So people who have actually not had the conversation about how we should be splitting equity, they end up having lower pre-money evaluation, okay? And then founders who accept an equal division of shares, on an average, this is just data that shows that they're making on an average about $500,000 less in valuation per person, right, across the whole thing. So why is that? Why is that when you are part of, and they're not looking at anything else, right? They're basically looking at whether you're split the equity 50-50 or not, or 30-30, whatever, equally, however many partners are. And they are looking at how quickly you decided that you are going to split it equally, which means you didn't have what I call the prenuptial conversation, right? So they tend to build less valued companies. Why do you think that is? Because the research doesn't give you any reason why that is. It just is a fantastic econometric study that does the data work very well. It has no explanation. Yes?
Yeah, it said that the teams that had more experienced founders, so people in, they had less equal splits. So I see it basically that the team that's faster to split it up. The first time I started a company, we were completely equal splits.
Yeah.
Second time, we're not.
So what changed in your case?
I got more experienced, basically.
Yeah, but then,
brought stuff to the table.
so you just say, I have experience, so I get more?
Yeah, actually, in this case, I also started a company and found us afterwards. So that's another thing. But I think that's the reason that the people with more experience, they have a more varied, equal composition, and therefore, since investors evaluate experience more than anything else,
Yeah.
they get a high valuation.
And also when people are more experienced, they learn a little bit more about equity relationships,
Exactly,
right?
yeah.
They're not just thinking that, 50-50 means 50-50 decision rights, that everything 50-50 rewards. It's not that simple, right? It is more complex, and the structure allows you to write more complex contracts. So you learn some things about equity as well, which is kind of fascinating to me.
And that skill you can use to negotiate with investors also. So
Absolutely, absolutely. So, okay, so here we go. So how do you decide who gets more? Assuming that 50-50 is a bad idea for a variety of reasons, starting with the simple practical thing that what happens if you don't decide or one partner dies or something, just life happens, and a lot of the time, these problems happen not when the company is not doing well. It happens when the company starts going well, actually, when there's actual, moolah to split. So the issue is assuming equal splits are not okay. How do you decide how to split? Who gets more? He has more experience, so he gets more. All that tells me is that the other person, for some reason, is thinking they know even less about equity, so they, okay, maybe he knows, and they're letting him. I'm not sure that's a good enough reason. Yes?
I think the more skin you put in the game, the more equity you will.
And how do you know how much skin you're putting in the game?
Well, that can change over time.
What if we are going to do this full-time together? We have different skills in the sense that you're a tech guy, I'm a marketing gal. But we're going to work full-time. We're putting equal 40,000 kroners to get started. How do you decide? This is a really interesting puzzle. First of all, a lot of my inexperienced students, the entrepreneurs, don't want to have the conversation, right? They don't want to have the prenup conversation. They're too much in love. And then they don't know how to think about this, right? We don't teach this. There's nothing there. Yes?
I think the way that we've done, at least that I've done now, is that we found out along the way, basically.
Exactly. Everybody learns this the hard way.
Yeah.
This is what it just surprises me that people have learned, and plus they don't even talk to each other. Even investors who have seen like 10, 12, 20 companies, they don't have good reasons on how we should be splitting it. Did you have a point?
Yeah, that I've gone through this as well, that it is really difficult. I know one time, there's no one way of doing it, but of coming up with a bunch of different factors that contribute time, commitment, money, experience, and then weighting them with the amount of equity, and then also doing cliffs for project accomplishments.
Yeah.
Was one motivation for me.
So who came up with that idea? Where did you get that idea from?
Well, it's been something that I've kind of, I think it was maybe an investor that had kind of said that's how they did it, and I thought that it sounded like a really good idea.
Okay, we really are living in the land of folklore when it comes to equity, when it's like the most important. And especially Mike O'Donnell, remember the Silicon Valley entrepreneurs have gotten very good at this. They mastered it. Nobody is like Tiger Woods playing golf. They have not actually written down, they don't have a logic. But my idea is when you go and actually study them, they know something the rest of the world doesn't know about equity. That's one of the things I've realized. You are getting closer, right? So I'm going to give you in one slide what I think I know so far. But don't hold me to it yet because the research is still in progress. But the idea of equity, we are beginning to understand a lot better, right? So I'm going to summarize that to you in 4 points. So here we go, right? The first thing, as you said, that you came up with some kind of a weighted average of what people are bringing to the table, right? Which is compensation. So if you have intellectual property, I'm bringing some extra money, or he has a lot of networks, or he's maybe she's a technology whiz. We're taking all these inputs into the venture, and you're weighting. Equity is a kind of a compensation for that, right? So that is one way people think about equity, right? But it's important to know equity need not be compensation. What is an alternate way to do that? I can actually, as part of the company, we can actually write a contract where the company owes you a certain amount of money for intellectual capital. You can actually write a debt contract for somebody who's bringing in money. You can write a different kind of a compensation based on you don't have to give equity for a compensation. Yeah, absolutely. So if you don't have, but you can still make it just deferred salaries. And accounting, you don't have to give equity because you don't have the money to pay the salaries. You can just have the salary can be shown as something the company owes, right? It doesn't have to be. That's all I'm trying to show. The other thing people think is, I need equity because I want a piece of the upside. So investors are thinking, they're doing valuation and they're thinking, I need 30% of the company because they have some returns in mind and they're calculating, putting a valuation today, valuation 5 years from now, and they're saying, I need this much return at least on my investment. And so they're doing this calculation. But even founding partners think, oh, I want a bit of the upside. The technology person thinks, I want some equity because I want an upside. But you can give people, you can own 50% of the company and actually give 70% of the returns to the other person if you want. You don't have to have equity, need not be tied to rewards. Finally, people think that if I have 51%, that my students always do this, 51% of the company, then I have decision control, I have rights. And investors know all, you take 30% and then you have all kinds of rights on all kinds of important decisions. So you don't have to have 51% of the company to have all the rights. So what does equity buy you if it is not really compensation or rewards or decision rights? That's the real puzzle. And this is where the magic of Silicon Valley is fascinating. Because people kind of over a period of, and a lot of experienced entrepreneurs and investors in this room, I'm sure, also understand this. They might not have articulated it in this way. That's the job of an academic, right? But they know this. This is one of the things they have learned the hard way. So what does equity actually buy you? And remember, this is actually the most important thing you have in the company, and there is only 100% of it. And Mike is right. You can actually do everything with just equity and no money. So it is terribly, terribly important, right? Yes?
I think you get to be a part of the dream. I think maybe that's the most important part of it.
Yeah.
You feel that you have this share, you're part of this dream or vision.
Yeah. You have this thing called ownership, and I'm asking you, what does that ownership buy you? The most important thing it buys you, you're absolutely right, it's part of the dream. It's not part of the prediction or the bet or anything. You get to shape the dream, right? So decision rights play a role, but you also get compensated for what you put in, and you also get a piece of the upside. You get all of them. It need not be any of them, but it can be all of them. And that is why, as an entrepreneur, I tell people, it's not about how much equity you own, it is how you use the equity. Does everybody understand what I mean by the joker in the pack? No? Do everybody play card games? And in the card games, you always have usually 2 in the pack, right? That can be any card you want. What do you call that in Danish? Joker, right? So equity is the joker in the pack. So if you are building an uncertain future, which could have huge upside, but it could also have downside, and you have an equity relationship, and the beauty of the equity relationship is the downside is not infinite. The upside can be very, very large. The downside is whatever the investor puts in, right? That's about it. I'm done. So the thing that people have become very good at through experience is how to use equity. So there are cases where an investor is pulling the plug and saying, we're going to close down this company, you're not doing very well. And the entrepreneur goes and says, I still own 30% of the, I still own 70% of the company or whatever, even if you have all the decision rights and you can actually close me down. Here, take my 70%. Give me 2 years, right? Let me prove to you I can just keep it as collateral. So people use They renegotiate, right? They do all kinds of really, really interesting things with equity that you can never do with a loan or even with cash. So this is fascinating to me, and this is one of the things I'm trying to study and bring here. And the simplest way I can convey this to you is to say that equity is like a joker in the pack. You can do all kinds of things with it. You can use it for compensation. You can use it for rewards. You can use it for decision rights. You can use it as collateral. You can turn, your relationship from equity into debt if you want. And you can also change it over time. Sometimes you pawn it. Sometimes you borrow. Sometimes you sell. You can do all kinds of things if you know the power of equity, which is what Mike O'Donnell was trying to say, that equity is everything, even though people actually say cash is everything. But cash and equity are really, really tied together in an entrepreneurial venture. So here we go. So I want to give you very quickly the findings on success and failure. I know I'm taking too much time, but I'll shut up in my part of the panel. How about that? So, and this I'm just going to simply read. People think that failure rates are very, very high with entrepreneurial firms. We have excellent studies, a whole series of them now showing that about half of all firms are around 8 years. They are still around, so they're not dead. Whereas 9 out of 10 of VC-funded firms are gone, right? Then 1/2 of the exit, right, of that, of that 50%, 1/3 of them were profitable at the time of exit. So they exited for reasons other than problems with the business. Less than 10% of ventures actually go bankrupt in the sense that they owe money to creditors, right? So the good news is that it's really not as risky as everybody makes it out to be. And the majority of firm failures are actually due to partners falling out, not due to lack of good management, markets, or money. So we're beginning to know this a lot. So what happens? If you can teach people to think effectually, including how to create and foster equity relationships, here is why this is exciting. I've not given you a lot of answers, but I've given you a lot of reasons to worry about understanding this deeper, and I hope you will work with me. Here's the thing. I love to say this thing. So this is what happened from the 17th century to the 20th century. What happened here? That all of a sudden there are so many PhDs and scientific journals and amazing technology in the 20th century. What happened here? The scientific method, right? Basically, Francis Bacon wrote Novum Organum, and he argued that there is a method for understanding the universe. You don't need, divine sight, or you don't need enormous amounts of money. It's not just a gentleman's pastime. There is a method to science, and it took 200 years for people to start teaching it to everybody. But the 20th century happened because we invested in educating everybody. We don't teach science only to future scientists. We teach science to everybody, so that, here we go. The scientific method enables not just scientists, right? It creates, it kind of enables democracy, technology, and the very idea of the middle class, that you don't have to die in the class in which you're born, that there is a logic to life and you can fight for it. So we are, in my opinion, the reason this is important, even though we don't know a lot about it, why we need to do and understand this and learn, both as, as a researcher, as an entrepreneur, as an investor, as a policymaker. One of the reasons you really want to do is not because you're suddenly all going to become billionaires, not because we're going to turn people into billionaires, but here is the thing. I think we can build a middle class of enterprises. So I just did this little calculation just for the fun of it. So you actually have fewer companies starting, and at the top end, you're not going to have any influence at all. You're just going to move this frontier just a little bit by teaching people the entrepreneurial method. Can anybody guess how many jobs that is? Sorry. That's like 20 million jobs. If you could, there are like thousands of $200,000 companies that could become $2 million companies, and a few $2 million companies that could become $20 million companies. So the effect historically that the middle class has, the middle class is huge, right? It enables everything that is modernity. I think we are looking at the possibility of an amazing thing that can happen if we can actually build out the middle class of businesses. If we don't have everybody starting just one-person companies and then, just being self-employed and then like less than 1/100th or 1,000th of 1% become billion-dollar companies. What we really want to work at is this. And I think it's possible to do that because we know a lot of the elements of the entrepreneurial method. And I think one of the most important mechanisms we need to understand is equity. And we're just beginning to understand it. So that's all I wanted to share with you. I'm very sorry for going over time.